John Deere has just posted its third straight year of declining profits. Net income has gone from $10.2 billion in 2023 down to $5 billion in 2025, wiping out roughly half the company's earnings in just 2 years. Heading into 2026, the CEO is publicly framing this as the bottom of the cycle, even while forecasting profits to fall further still. To understand where John Deere stands today, you have to understand where it was just 2 years ago. In fiscal 2023, the company reported $10.2 billion in net income, the most profitable year in its 187-year history. With revenue hitting $61.3 billion and margins running exceptionally strong, the agricultural equipment market was booming, fueled by record-high crop prices following pandemic-era supply disruptions. Corn, soybeans, and wheat were all trading near record highs, and farmers flush with cash were buying the most expensive equipment John Deere had ever offered. CEO John May stood in front of investors describing a company firing on every cylinder, framing it as more than just a tractor manufacturer, a precision agriculture company selling GPS-guided planting systems, autonomous sprayers, and connected farm management software, where the future wasn't simply green and yellow steel, but data, and John Deere intended to own it. For a brief moment, that confidence appeared entirely justified. That moment didn't last nearly as long as anyone inside the company seemed prepared for. The collapse began in fiscal 2024. Net income fell 30%, from $10.2 billion down to $7.1 billion, while revenue dropped 16% to $51.7 billion. The fourth quarter alone was brutal. Net income for that single quarter fell 47%, from $2.4 billion to $1.2 billion, with revenue down 28%. The company's official language pointed to challenging market conditions, a phrase doing a lot of heavy lifting. In plain terms, it meant crop prices had fallen sharply from their pandemic-era highs. Corn down 37% from 2022, soybeans down 24%, wheat down 35%. Farmers who had been spending freely suddenly watched their income evaporate, and the first thing they stopped buying was a new $600,000 tractor. The losses kept compounding into fiscal 2025, and net income fell another 29%, landing at $5.027 billion, while full-year revenue declined 12% to $45.7 billion. A company that had earned $10.2 billion in a single year was bought, now earning roughly half that and still sliding. Looking ahead to 2026, CEO John May told investors the company expects net income between $4 billion and $4.75 billion, calling it the bottom of the large AG cycle. What that actually translates to is profits declining for a fourth consecutive year. In 2024 alone, John Deere announced more layoffs than it had across the entire stretch from 2009 through 2022 combined. Not a typical down cycle, but something closer to a structural reckoning. And the financial figures tell you what happened to John Deere's balance sheet. The layoff numbers tell you what happened to the communities that built the company. In 2024, John Deere cut 2,167 jobs across its Iowa and Illinois facilities: Waterloo, Davenport, Dubuque, Ankeny, Ottumwa, Moline, and East Moline. The Waterloo plant alone, John Deere's largest tractor manufacturing site, went through 6 separate rounds of layoffs in a single year, losing 1,075 workers there alone. The cuts didn't slow down in 2025 either. The first week of January saw 112 jobs cut at Waterloo and 80 at Davenport. February brought 75 more at Ottumwa. August added another 238 across 3 Midwest facilities, and September saw 141 more. Altogether, more than 3,500 John Deere employees lost their jobs between October 2023 and September 2025 across the company's American Heartland operations. A retired John Deere employee who'd spent decades at one of the Iowa plants told reporters that the impact on the small Iowa towns built around these manufacturing facilities would be devastating, noting that nearly 1,000 workers had already been cut that year alone. The quote dates back to 2024. The cuts that followed made it sound almost conservative. The layoffs alone would have been painful enough. What made things explosive was what John Deere announced right alongside them. In June 2024, while cutting jobs in Dubuque, Iowa, the company confirmed it was shifting production of skid steer loaders and compact track loaders from Dubuque to a new plant under construction in Ramos, Mexico, scheduled to be operational by the end of 2026. This wasn't the first such move. In 2022, Deere had already relocated tractor cab production from its Waterloo, Iowa plant to Mexico. The United Auto Workers local union response was blunt. UAW Local 838 President Tim Cummings called on Deere to bring outsourced jobs back to its American factories, describing the layoffs and production shifts as an insult to working people across Iowa and Illinois. Deere's response stayed corporate and measured, pointing to roughly $2 billion invested in American manufacturing since 2019, and insisting the Mexico moves weren't connected to the layoffs. Communities watching jobs leave while a new factory rose in Ramos weren't particularly convinced by the fine print. The political fallout arrived quickly. In September 2024, Donald Trump threatened John Deere with a 200% tariff on anything it manufactured in Mexico if the production shift went forward, accusing the company of trying to manufacture more cheaply abroad while still charging American prices, profiting by cutting American labor and jobs. The Mexico plant construction continued regardless. The Iowa job losses continued regardless. And the 200% tariff threat eventually faded from the headlines. What followed carries an irony almost too sharp to be coincidental. The tariffs that ultimately did arrive, ones meant to protect American manufacturing, ended up hitting John Deere from an angle nobody had fully anticipated. Steel and aluminum tariffs raised to 50% drove up the cost of raw materials John Deere relies on for domestic production. A company already cutting American jobs to control costs now faced higher costs on the American manufacturing it. Had kept at the same time, broader trade uncertainty disrupted John Deere's export business as retaliatory tariffs from trading partners hit American agricultural exports, squeezing farm incomes in the very markets where John Deere sells its equipment. Farmers already buying less because of falling crop prices now faced added uncertainty about whether their grain would even find buyers overseas. John Deere CEO acknowledged in the fiscal 2025 earnings report that ongoing margin pressure from tariffs would be a defining feature of the business environment heading into 2026, meaning a company once threatened with tariffs for moving jobs to Mexico ended up absorbing tariff costs on its remaining domestic operations anyway. As one industry analyst summarized it, the tariff rhetoric didn't end up protecting any American jobs. It simply added another cost line to a company already under serious strain. John Deere's broader answer to the agricultural downturn has been technology, specifically precision agriculture, GPS guidance systems, autonomous machinery, and connected farm management software that CEO John May has framed as the company's route to premium pricing and recurring revenue. The logic holds up on paper. Embed software subscriptions and data services into the equipment, and the business becomes less hostage to commodity price swings. And since farmers who need the technology to run efficient operations will keep paying regardless of whether corn sits at $6 or $4 a bushel, The problem is that this transition is taking longer and costing more than the earnings reports suggest. The autonomous tractor John Deere, showcased publicly back in 2022, generated enormous media coverage, yet 3 years later, commercial deployment at real scale remains limited. Precision agriculture revenue, meant to cushion the broader downturn, hasn't grown fast enough to offset the collapse in equipment sales. Meanwhile, competitors are closing the technology gap. CNH Industrial, owner of Case IH and New Holland, is investing heavily in its own precision agriculture platforms, while AGCO, owner of Fendt and Massey Ferguson, acquired Precision Planting to build out its digital agriculture capabilities. The window John Deere had to lock in an unassailable technology lead is narrowing, and the company is trying to defend that lead while simultaneously managing a financial downturn, workforce reductions, and a political controversy over its Mexico strategy all at once. So what comes next? John Deere isn't in existential danger. Its balance sheet remains solid. Its brand recognition across global agriculture is unmatched. And its construction and forestry division, which posted a 27% jump in operating profit in Q4 2025, offers some counterweight to the agriculture downturn. And the CEO himself believes 2026 marks the bottom of the cycle, implying recovery starts in 2027. But hitting bottom isn't the same as recovering, and the structural questions facing John Deere don't disappear once crop prices rebound. The Mexico production strategy has damaged the company's relationship with the American farming communities that have been its most loyal customers for generations. A retired dealer who spent decades selling John Deere equipment in Iowa put it simply, farmers buy this expensive equipment partly because it's built by American union workers. And once that's taken out of the equation, there's less left to justify the price, and that matters because John Deere's premium pricing, the $600,000 tractors, the $300,000 combines, has always rested partly on what the brand represents, not just on raw machine performance. Buying a John Deere from a small-town Iowa dealer used to connect a farmer to something larger than a piece of equipment. And if that connection erodes, the pricing power underpinning John Deere's margins erodes right along with it. The technology strategy is genuinely the right long-term direction. Autonomous equipment, precision planting, and connected farm management represent where agriculture is heading, and John Deere clearly knows it and is investing accordingly. But that transformation demands patience, capital, and trust from the farmers it serves, arriving at precisely the moment when farm incomes are down and jobs are heading to Mexico. And the political climate has turned John Deere into something of a symbol for everything American workers fear about globalization. Net income peaked at $10.2 billion in 2023 and is projected to fall to between $4 billion and $4.75 billion. In 2026, that's not simply the bottom of a cycle, that's a company being forced to rebuild its identity, its workforce model, and its technology strategy all at once, while the financial cushion it needs to manage all three keeps shrinking every quarter.